Good evening, and welcome to the Crypto Overnighter. I'm Nicodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific on Tuesday, September 12th, 2023. Welcome back to the Crypto Overnighter, where we have no sponsors, no hidden agendas, and no BS. But we do have the news, so let's talk about that. Tonight, we're diving deep into the legal labyrinth engulfing FTX and its founder Sam Bankman-Fried. We'll also explore why the FTC is going after Celsius CEO Alex Mashinsky. If that's not enough legal drama for you, we have updates on the SEC's standoff with Grayscale investments. On the regulatory side, find out how the FCA is shaking up crypto investments in the UK, starting with Luno. And for a change of pace, we'll delve into the chilling tale of how Ethereum co-founder Vitalik Buterin got SIM swapped. Finally, PayPal is making its own waves in the crypto ocean. Stick around, you won't want to miss this. FTX is embroiled in a complex legal battle with the U.S. Department of Justice. The DOJ has been accused of overreaching by attempting to block all 7 of Bankman-Fried's proposed expert third-party witnesses from testifying. The defense argues that this move undermines Bankman-Fried's right to a fair trial. In preparation for the trial set to begin in October, both the defense and the DOJ have proposed questions for prospective jurors. These questions aim to identify any potential biases among the jurors, especially those related to cryptocurrency or the case itself. Bankman-Fried's bail was revoked last month, and he's currently in jail. FTX's assets are valued at approximately $7 billion, including the $1.2 billion in SOL tokens and 38 properties in the Bahamas appraised at $199 million. The company also holds $560 million in Bitcoin and $192 million in Ether. FTX filed for bankruptcy last year, and since then, nearly $2.6 billion in cash has been secured. The company is facing claims worth $65 billion, including a $43.5 billion claim from the United States Internal Revenue Service. Over 36,000 customer claims worth $16 billion have been filed against FTX. The company is also exploring the possibility of resuming business and has contacted 75 potential bidders for this purpose. The DOJ's aggressive stance against FTX and its founder raises questions about the fairness of the legal process. This is especially concerning for the crypto community, which already harbors distrust towards governmental institutions. The attempt to block expert witnesses could be seen as an effort to control the narrative, potentially skewing the trial in favor of the prosecution. The asset portfolio of FTX is another point of interest. With billions in various cryptocurrencies and real estate, the company's financial dealings are under scrutiny. The fact that FTX is considering resuming business adds another layer of complexity to this already intricate case. The sheer volume of claims against FTX is staggering. The $43.5 billion claims from the IRS alone could have far-reaching implications for the crypto industry. If the IRS's claim is validated, it could set a precedent for how crypto assets are treated by tax authorities. Now, if you thought the FTX situation was a labyrinth, wait till you hear about Celsius CEO Alex Mashinsky. The regulatory sharks are circling, folks, which seems to be coming up a lot. Is this the new normal? Keep listening to find out. And hey, if you're liking what you're hearing, don't forget to follow and enable notifications. Alex Mashinsky faces his own legal battle with the Federal Trade Commission. Mashinsky was arrested in July on allegations of misleading investors and manipulating the SEL token. His arrest came after Celsius filed for bankruptcy last year. Mashinsky pled not guilty to multiple counts of fraud and manipulating the price of the SEL token. His lawyers argued that the allegations did not support a claim. They say that the court should dismiss the FTC's claims that he misled investors. Mashinsky's former chief technology officer, Hanouk Nuke Goldstein, is also contesting the charges. Both argue that the FTC would need to make more rules before taking on novel cases like this. U.S. Attorney Damian Williams has asked the court to put FTC proceedings on hold to avoid prejudicing a parallel criminal case. Mashinsky was released on a $40 million bond, and his banking and real estate assets have been frozen. From the outside looking in, the FTC's case against Mashinsky and Celsius is indicative of the regulatory scrutiny that's becoming all too common in the crypto space. Mashinsky's lawyers are challenging the very foundation of the FTC's case, questioning its applicability under existing financial laws. This could color how regulatory bodies approach crypto companies in the future. Goldstein's involvement adds another layer of complexity. He is essentially being held guilty by association, a tactic that could be seen as the FTC's grasping at straws. If the court sides with Mashinsky and Goldstein, it could signal a significant setback for regulatory bodies like the FTC, which seem eager to clamp down on the crypto industry. The $40 million bond for Mashinsky's release and the freezing of his assets are not just punitive, but also indicative of how seriously the U.S. government is taking these cases. It says that the government is watching, and they're not afraid to pull out all the stops to enforce their interpretation of the law. So what's the takeaway here? The legal battle between Mashinsky, Goldstein, and the FTC is a microcosm of the larger tension between the crypto world and regulatory bodies. This could have far-reaching implications for the future of crypto, especially in a regulatory environment that's becoming increasingly hostile. From the FTC to the SEC, regulators are making waves. But here's a plot twist. What if the courts side with the crypto companies? We're diving into the SEC's dance with Grayscale investments next. SEC Chair Gary Gensler recently told lawmakers that the agency is still reviewing a court decision that favored Grayscale investments in its push for a spot Bitcoin exchange-traded fund. This statement came during a Senate Banking Committee hearing where Senator Bill Hagerty questioned what the SEC needed to see in a filing to approve a spot Bitcoin ETF. Gensler responded that his agency was reviewing multiple filings related to Bitcoin exchange-traded funds. In August, 3 judges from the U.S. Court of Appeals for the D.C. Circuit ruled that the SEC must re-review Grayscale's bid for a spot Bitcoin ETF. This came after Grayscale sued the SEC last year, following the rejection of its plan to convert its flagship GPTC fund. The court specifically addressed the SEC's differential treatment of spot Bitcoin ETFs and similar funds based on futures contracts, which the SEC has approved. Several firms, including BlackRock and Fidelity, filed for spot Bitcoin ETFs. Experts believe the Grayscale's court decision could tip the scales in their favor. Grayscale sent a letter to the SEC last week urging the agency to approve its spot Bitcoin ETF. The SEC still has the option to request a rehearing with all 3 judges. After 45 days, the court will issue a final mandate detailing the next steps. The SEC could also seek a review of the decision in the Supreme Court. The SEC's ongoing review of Grayscale's court win is a litmus test for the agency's stance on cryptocurrency. The court's decision to make the SEC re-review Grayscale's bid exposes the regulator's inconsistent approach to crypto-based financial products. It's not just about Grayscale, it's about leveling the playing field for all firms in the crypto space. The Senate's involvement adds another layer of scrutiny. The questions posed by Senator Hagerty are questions we all have. What does the SEC need to see to give the green light? The fact that these questions are coming from the Senate indicates a broader interest in crypto regulation, or perhaps the lack thereof. Grayscale's aggressive push, backed by a court ruling, puts the SEC in a tight spot. The agency cannot afford to drag its feet any longer. With multiple firms like BlackRock and Fidelity entering the fray, the SEC's decision will set a precedent. And let's not forget, the clock is ticking. The SEC has 45 days to make a move, and that move will send ripples across the crypto world. Frankly, the SEC's inconsistent policies and opaque decision-making processes have left the crypto community skeptical. This case asks a critical question. Will the SEC finally align its policies with the evolving crypto landscape, or will it continue to be a roadblock? Next up, we're crossing the Atlantic. The FCA is shaking up the UK crypto scene, starting with Luno. Is the UK setting a precedent that others follow? Stick around to hear more. And remember, if you're liking the show, hit that like button. Luno is a cryptocurrency exchange, at least for now. We'll see. For now, Luno is temporarily halting some of its services in the UK. This move comes in anticipation of new regulations from the Financial Conduct Authority. The suspension will commence on October 6th, just 2 days before the FCA's new rules are set to take effect on October 8th. Nick Taylor is Luno's head of public policy. Taylor stated that these changes are in line with the FCA's new regulations, which have prompted all compliant crypto firms in the UK to make adjustments to their platforms. For those affected by the suspension, Luno has clarified that they will still have the option to sell and withdraw their investments. The FCA's new rules are quite stringent. They require that all cryptocurrencies be classified as restricted mass market investments. Now, we've talked about some of this recently. This classification mandates that all crypto promotions and advertisements must contain clear warnings about the associated risks. Furthermore, the FCA has prohibited the use of promotional incentives like refer a friend schemes or new joiner bonuses. To give firms time to comply, the FCA extended the deadline until January 8, 2024. The FCA's new regulations represent a significant shift in the UK's approach to cryptocurrency. Luno's decision to halt certain services ahead of these changes is a clear indicator of the regulatory environment tightening around crypto businesses. While the FCA claims that these new rules aim to protect consumers, the implications suggest an increase in centralization and control, which is antithetical to the ethos of the crypto community. The classification of crypto as restricted mass market investments could potentially stifle innovation and deter newcomers from entering the crypto space. Moreover, the ban on promotional incentives like refer a friend could dampen the community-driven spirit that has been a cornerstone of the crypto world. The FCA's decision to extend the compliance deadline to 2024 may offer some respite, but it sends a clear message that the regulatory scrutiny is intensifying. Luno's preemptive action raises several questions about the future of crypto in the UK. Will other exchanges follow Luno's lead? And could these UK-specific regulations set a precedent for other countries? While the FCA's rules are localized, their impact could have far-reaching consequences, affecting the crypto landscape well beyond the UK. We've talked about legal and regulatory battles, but what about good old-fashioned hacking? As we've seen before, even Ethereum co-founder Vitalik Buterin isn't safe. Vitalik Buterin recently fell victim to a SIM swap attack. The breach occurred on September 9th, targeting his X account. Hackers manipulated T-Mobile to gain control over Buterin's phone number. Then they exploited two-factor authentication to access his social media account. The attackers posted a malicious phishing link, leading to financial losses for those who clicked it. A staggering $691,000 was stolen, with 73% of that being NFTs. Tim Biko is another Ethereum developer. He advised users to remove phone numbers from X accounts and to enable 2FA. T-Mobile has faced similar allegations before, including lawsuits for enabling the theft of millions in cryptocurrencies. Buterin regained control of his T-Mobile account, but not before the damage was done. He revealed these details on Farcaster, a decentralized social media platform. The hack led to a fake NFT giveaway, causing victims to lose more than $691 million. Buterin's father, Dmitry Buterin, was the first to acknowledge the hack. The attackers even sent Buterin an NFT that they'd stolen. This is not the first time that the Buterin family has been targeted. Vitalik's mother also was the victim of a Twitter exploit earlier. The SIM swap attack on Buterin shows the vulnerabilities that still plague the crypto space. While the crypto community often touts decentralization and security, this incident shows that even the pioneers are not immune. It's a wake-up call, especially when the exploited platform is as big as T-Mobile. The incident also highlights the inherent risks of linking phone numbers to social media accounts for authentication, a practice that's unfortunately still prevalent. It's not just about individual caution, it's a systemic issue that needs addressing. The advice to enable 2FA and to remove phone numbers is sound but reactive. What's needed is a proactive approach to security, especially for accounts with substantial followings in the crypto space. Moreover, this isn't just a one-off event for T-Mobile. The service provider has a history of being susceptible to SIM swap attacks, raising questions about its security measures. Now, the fact is, your security is only as strong as its weakest link. And right now, that link appears to be the traditional systems we're still reliant upon. So trust but verify. But maybe just don't trust so easily. Especially when it comes to centralized systems that have shown time and again that they can be manipulated, even to the detriment of crypto veterans like Vitalik Buterin. Now let's talk some progress. PayPal is diving deeper into crypto. What does this mean for you and me? Find out in our final segment. And if you haven't yet, make sure to subscribe for more crypto insights delivered right to you. PayPal launched a new service that allows users to convert their cryptocurrencies to USD. This new feature is an extension of PayPal's existing on-ramp service, which enables customers to buy cryptocurrencies. The off-ramp service is currently available to US users and is live on MetaMask. It's also accessible to wallets, dApps, and NFT marketplaces. PayPal has emphasized that this service comes with robust security controls and tools for fraud management, chargebacks, and disputes. The company has been making significant strides in the crypto space. Just last month, PayPal launched its USD-backed stablecoin PYUSD on the Ethereum blockchain in partnership with Paxos. This stablecoin will soon be available to PayPal's US customers. Furthermore, PayPal has also partnered with Coinbase to offer cryptocurrency transactions in Europe, making it easier for Europeans to purchase cryptocurrencies. Ledger also integrated with PayPal, allowing US customers to buy cryptocurrencies like Bitcoin and Ethereum. PayPal's move to introduce an off-ramp service is a strategic one. It's aimed at capturing a larger share of the crypto market. It's not just about providing a service, it's about establishing a stronghold in a space that's increasingly becoming mainstream. The company is clearly trying to be a one-stop shop for crypto services, from buying to selling, and even offering a stablecoin. The introduction of PYUSD, PayPal's own stablecoin, is another masterstroke. While Meta's stablecoin venture failed, PayPal's is seeing some success. Why? Because PayPal has the infrastructure, the customer base, and most importantly, the trust of its users, something I'm not sure Meta ever had. It's a clear signal that PayPal is not just dipping its toes in the crypto pool, it's diving in head first. So what happened? FTX is facing a complex legal battle with the DOJ, jeopardizing its assets and challenging the fairness of the legal process. The DOJ's decision to block expert witnesses has sent ripples of concern across the crypto community. Celsius CEO Alex Mashinsky is wrestling with the FTC over allegations of misleading investors. This case could set a precedent for how crypto companies are regulated, affecting the future landscape of crypto law. SEC Chair Gary Gensler hints at an ongoing review of Grayscale's bid for a Bitcoin ETF, following a court ruling in Grayscale's favor. This could level the playing field for other firms vying for spot Bitcoin ETFs. In the UK, Luno has voluntarily halted some of its services ahead of stringent regulations from the FCA. This move could indicate an era of tighter regulatory controls on crypto firms, not just in the UK, but globally. Ethereum's Vitalik Buterin became the latest victim of a SIM swap attack, shedding light on lingering security vulnerabilities even among crypto pioneers. Lastly, PayPal is diving deeper into the crypto space with its new off-ramp service, offering more options for crypto conversions and signaling its intent to become a one-stop shop for crypto services. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating, or maybe a review. And in the meantime, we'll see you tomorrow night.